Jangu Joy.
Excuse me, Victor.
Yes, Pastor Mande.
Maybe if you could be sharing the screen, there are things I missed network about the Genze. Those last points.
Atoba tutandikira wao.
I was at the inventory evaluation, that one there, as we are waiting for these guys to join. Thank you. I ended at inventory evaluation. That one had finished it, that point had finished it. So you can move up a bit, yeah. Yeah, thank you. Katono once. Yes, thank you there.
I'm hoping everybody is back now. Online team is not yet back. Looks like the online team, they've extended their lunch break. Maybe they are government employees. Okay, regardless, let's get started. So let's gather back to our question. So I want to talk about auditing procedures. We have some questions here, or some question here about auditing procedures, but then I'm also going to talk about them in general. And what do I want to talk about audit procedures? Auditing procedures, I think you must have seen by this time, we always have a question somewhere on number one on this on this area. So what that means, we somehow have to be ready and prepared for a question of this kind. What is the hack to making it a bit simple and less tiring? Because we have many areas. We have receivables, we have payables, we have cash and bank, we have revenue, we have cost of sales, operating expenses, we have payroll, we have property, plant and equipment, we have inventory, we have share capital, we have accruals, we have, I'm already at 11. Like we have many areas. I haven't talked about going concern. I haven't talked about, like, think of, there are many and many areas that can be asked. We have deferred tax, we have work in progress, we have, I don't know, like there's borrowings, like you can't even list them and finish them. So how can we make sure that we are ready for those auditing procedures? Because we know the examiner, surely the examiner can go and pick any of those what? Any of those topics. Sorry, not topics, areas. The number one thing that we should think about is, do we understand the assertions? Because if you understand the assertions, then it becomes very easy for you to bring out these audit procedures. If you understand assertions, or you promise me that you're going to understand assertions after here, then clearly it's going to be easy for you to do what? To come up with these auditing procedures. Then the other thing which I also encourage students to really depend on, there are those which are free marks. These are the only two things that I want to talk about auditing procedures. Free marks. When I talk of free marks, they are auditing procedures which are like constant, which are like too generic, right? And you can apply, and most of these you can actually apply them on every area of the financial statements, right? So let me start with the free marks. Who can tell us the first one, which is the free mark? Okay. Which
Read the minutes of previous meeting.
Reading the minutes of the board meeting. Does that apply everywhere? This will not apply everywhere, but it will apply in most of the areas. The very first one, which is a very, 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 very free mark, containing a representation letter.
Management representation.
Management representation letter. With respect to, you put the area which you have been asked. It could be property, plant, and equipment. It could be receivables. It could be borrowings. That is one. That one normally is going to remain like that. Whether you're auditing whichever area, this thing is going to be applicable. The next one is another disclosures to the financial statements. Check that they comply with the financial reporting framework. Because every area in the financials really has notes and disclosures, those disclosures that we have. So every standard has disclosure requirements. So most of the areas of the financial statements, really reading the notes and other disclosures is an audit procedure that you can depend on. The other one is the analytical procedure. This is not the point, but I mean, that's what I can call it. But the point is compare let's assume I'm using PPE. The PPE balance in the financial statements to prior year and obtain explanation from management. Any significant difference, you obtain explanations from management. This is an analytical procedure and it can really apply on every area. Whether you're auditing receivables, you can say, compare the receivables balance in the financial statements to the previous financial year and obtain explanation from management for any significant movements or variations. If you're auditing revenue, same thing. Obtain the compare the revenue amount in the financial statement to the previous financial year and obtain explanation from management for any significant movements. If you're auditing cash and bank, same thing. If you're auditing payables, same thing. If you're auditing inventory, same thing. That's why when we are presenting financial statements, we always present current year and previous year. Even when we are doing this question, you saw we had 2020 numbers and 2021. That is the analytical procedures, and it helps you with, it helps us with it helps you with coming up with this. Okay, so those who are just coming in, we are talking about auditing procedures in general, right? We're not answering the specific question that we had in the paper we are doing. I am just giving an overview of the things to look out for under auditing procedures. And I was saying that they are basically points which are like free points, right? Those procedures which cut across many areas and which which will just apply to any area of the financial statements, provided you've been asked for audit procedures. Then there is the other one, which is only applicable to balance sheet items, the one for obtaining a listing. Cast it and check that it agrees to the financial statement. What this means is that if you're auditing receivables, it will be a receivables listing. If you're auditing payables, it will be a payables listing. If you're auditing cash and bank, it will be maybe a listing of all bank accounts and balances. If it's your auditing inventory, it's going to be the stock or inventory listing. If you're auditing, which other thing can we audit? Non-current assets, it's going to be the asset register, right? If you're auditing prepayments, it's going to be a prepayment schedule. If it's accruals, you have an accruals summary. So whatever you're auditing, for as long as it's balance sheet items, there is really that procedure about obtaining a listing, a schedule, or a summary. And that test is a test on completeness. That's all I can say about the free marks. Then we have the assertion. The assertions are supposed to help you to come up with these auditing procedures. I like giving an example of how would you confirm that Capital College owns a vehicle if they are saying they had a vehicle. How would you confirm that they actually own it?
If they have a logbook for that
They will
vehicle.
have a logbook, right? So that procedure helps you to validate rights and obligations. And it's as simple as inspect documents of title, ascertain ownership of this asset. If it is a motor vehicle, you will have logbook. If it is land, you will have a land title. If it is what else has those documents? If it's what else has the document of title? If it's a lease, you have maybe a lease agreement or something, right? But we have that auditing procedure whereby you can review documents of title and ascertain ownership of the asset, right? That is one. So your understanding of the assertion can simplify it for you to come up with the auditing procedure. Which other assertion do we have for the balance sheet items? Existence, right? We apply it on what? Which, sorry? On assets, non-current assets. Someone is saying we apply existence on non-current assets. You can physically inspect the assets to confirm that they do exist. You go and see them. If it's a building and they are constructing, there's a question, I think, in 2023, 2024 or 2023, where they were asking auditing procedures for construction work in progress. You go and visit the site to confirm that the building actually what? Exists. As simple as that. It's an audit procedure, right? Level of completion, yes. You can also assess the level of completion of that, of the building. What I'm trying to arrive at, what I'm trying to drive at is that you can use those assumptions to come up with auditing procedures. If you want to confirm existence of receivables, what are you going to do? You obtain confirmation letters. Sorry? Circularize. Yes, 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 yes. You can obtain direct confirmation of balances from customers. That applies to customers or suppliers. If you want to verify existence of stock, what do you do? You attend and observe their end inventory counting, right? That is that's existence, right? What if you want to valuation of which area? Tell us. Valuation of inventory. So Rosemary is telling us we want to validate valuation of inventory. What procedure would we do? Joseph, what procedure can we do? Recalculate. You want us to recalculate the value of inventory. So that's too much.
Invoices.
We can inquire from management the basis of standard costs, maybe in case we are using standard costing and valuation, right? That's one example. We can review any slow-moving inventory and ascertain if there is any impairment losses, right? So we can review slow moving, we can review the stock movement report and identify any slow moving stock which needs to be written. How can we ascertain valuation of receivables? Valuation of receivables, how can we audit it? Okay, valuation of receivables. You want to verify that your receivables are properly valued. What procedure would you do? If receivables are to be valued poorly, what would happen?
That would be an overstatement of receivables.
Yes, but what would happen for them to be overstated? If you have irrecoverable receivables that you haven't provided for, that's when you would have your receivables overvalued, right? So what would you do now as an audit procedure? I can review the aging report and identify any irrecoverable receivables and check that they are properly provided for the financial statements. Or I can also review the entity's provision for bad debts and verify that it is sufficient. I can review the provision for bad debts and check that it is sufficient. Because the moment they give a wrong provision for bad debt, then your receivables are going to be overvalued. Are we together? Which other assertion do we have for balance sheet? Cash. Cut off. Balance sheet and cut off. It will apply on things like stock, because stock comes from purchases, but it won't apply on things like property, plant, and equipment. It won't apply on things like receivables or payables. Yeah. Someone is mentioning presentation and disclosure. I think that one we talked about it. The procedure is among the 3 marks. So you read the notes and other disclosures to the financial statements and check that they are complying with the financial reporting framework. Still on existence. So now it's okay. So but I just wanted to first show you that when you are thinking about auditing procedures, think assertions, and the assertions are going to simplify this for you. They are going to show you how to pick out audit procedures. But of course, once we go to the specific areas of the financial statement, they have different ways of how we can verify certain things, right? For example, one of the things that we have said under existence of non-current assets, you can physically inspect them, right? But if you cannot physically inspect them, what would you do? You've seen the PPE shed. The PPE shed, those are just records. They won't show you that the thing is actually there or not. Yes. You can review the maintenance costs. Yeah, but you have to explain it well. What if, instead of that, why don't you talk of reviewing the revenue? You can review the revenue invoices for income generating assets. That gives proof of existence, right? Like people who audit airlines, you're not going to go around looking for aircraft because they're always in the sky, right? But yes. But if the aircraft shows bookings and revenues and flights, then that is proof enough that it does what? Exists, right? If Flash has a tractor that earns her monthly rental income, the one proof is she's leased it to these people and they are paying money is coming in on the what? On the bank. That is proof of existence. That is why we have a procedure of review sales invoices, a sample of sales invoices to verify existence for revenue generating assets. That's one example. Sorry, that's one procedure. On top of physically inspecting them and confirm that they do exist, then you can review the insurance policies. The insurance policies give you proof of existence because you cannot insure something that does not exist unless you are a mufele of your own. But normally, even insurance is not supposed to do what? To cover something that does not exist. So part of the procedures you can do is review our insurance policies and check that the assets are sufficiently covered. What else? What other procedure can we have under existence? These are enough. Which other assertion do we have? Completeness. Completeness is obtaining the asset register, cash it and check that it agrees with the financial statement. The other thing we do under non-current assets completeness is reviewing the asset movement schedule. You see that asset movement schedule where we have opening balance, we have additions, we have disposal. Should you have any issue with your details, that thing is not going to do what? It's not going to balance. Even if you sold like an asset and you don't recognize it, you try to reconcile it and it won't be reconciling. So it can only reconcile if your assets are what? If everything is recorded correctly. Any other assertion we can talk of on PPE? We talked about rights and obligations. We talked about There's completeness. Do you know about completeness? What else? What else? What else? What else? Accuracy for balance sheet, normally we refer to that as valuation. Just a valuation for property, plant, and equipment. What would we do? Give us a procedure. Valuation. Did I tell them what you asked me? Eh? I tell them. No, it didn't require an answer. Just what are we even doing? Okay, so you have an answer for her. Give us.
Carried out based on the various assertions made by management. So he's asking us on the assertion of valuation and how we work procedure.
Okay, so valuation on property, plant, and equipment, we have a number of them. When you talk of valuation of property, plant, and equipment, these are non-current assets. How do we value them? Cost less accumulated depreciation. So your procedure is supposed to be rotating around that. But we also have those that we carry on revaluation model. So the procedures that we have under valuation are going to be, for example, of additions, you can agree the cost of the assets to the purchase invoices, right? If you bought a vehicle at 600 million, that is what is going to be in your financial statements. For me to confirm that this value is correct, I can agree to the purchase invoice from the what? From the supplier. For example of additions, agree the cost to the purchase invoices from suppliers. That is one. The other thing we can do on valuation is you can review the depreciation rates used and check that they are reasonable. Because the moment you mess up with the depreciation, then you're going to mess up with valuation of the what? Of the assets, right? I think that's clear. Then the other thing that you can do is you can compare the depreciation rates to the asset. Or didn't I talk about that already? Maybe that's the explanation. When you're looking at depreciation rates, this is what, if someone says that the rate they are using is 5%, it means the asset has 4 years useful life, right? So for you to assess if this percentage is actually correct, you compare the depreciation rates to the asset replacement policy. That is what tells you that this percentage is what? Reasonable. If you come and say 25%, but you're replacing computers everyone, then you maybe should be using 100% in a what? In a year, right? Otherwise, the rate you're using could be misstating the what? The assets. What else do we have on assets? Other than depreciation, we have impairment, right? So what procedure do we apply there? You check that assets are tested for impairment at least annually, right? So impairment is also one of the things that affects the assets valuation. Then for revalued assets, you agree the revalued amount to the valuation report. For revalued assets during the year, you agree the revalued amount to the valuation report. Independent valuer, yes. That's for revalued assets. Is there anything else on valuation? That's enough. The others you can add on as you revise. And the assertion is done. I feel like there are classification. Let's save that for P and L. Normally, when you talk of presentation and disclosure, we're sort of like done. Classification normally comes out strongly for balance sheet items under borrowings. where we have to classify the borrowing into both current and non-current. But for these other things, not so much big. Are we together? I don't know. Yes. For currency, now you've gone to the P&L. Yes. So for currency in non-current assets, when you buy something like a non-current asset or for anything in the balance sheet, by year end, because we're dealing with balances, they will be existing. So occurrences is to be a P&L, sorry, balance sheet asset, but rather a P&L asset because it's one that looks at events that have occurred. Yeah, those are enough. If I'm to talk about like receivables, valuation, completeness, how would I verify it? I want to confirm that these receivables are complete. What procedure would I do? You obtain the receivables listing, you cast it and check that it agrees to financial statements. That's completeness. What else would you do on completeness? Anything? Christy, is everything okay? You're not talking. I didn't. You were seeing the communication. And she was here on Saturday. Anything else on completeness? Okay, you look like you want to tell us something. No, you don't tell us anything. You should always be ready to tell us something. The other procedure I have on completeness is checking or reviewing any receivables with credit balances and check that they are reclassified to payables. Because when you have receivables with credit balances, they will always appear as negatives against your receivables, which affects the overall balance. Valuation, we talked about it. Another thing that we have on valuation is for like foreign denominated balances, checking that they are translated using the closing exchange rate. That is IS 21. That speaks to valuation. Yeah, what else? Completeness. Did we talk about completeness? Receivables completeness. Oh no, we talked about it. Valuation we did. Existence we talked about it briefly. On the confirmations, I think those are enough. You add the 3 marks and off you go. Anybody has a question on auditing procedures? Yes. No, you could read what? Okay. Because I was specifically still talking about the balance sheet. Maybe I didn't like specify, but I think my every time I was talking of balance sheet. That's why I was talking about receivables, PPE, but then we also have the P&L assertions. So let's talk about the P&L. If you're auditing anything in the P&L, you're dealing with transactions and events, right? The assertions are also there. They are different. So the assertions we have for P&L, we have completeness, we have occurrence, we have cutoff, the ones that you guys were interested in. We have classification. Which one is the other one?
Existence.
Accurate. I hope I didn't share somebody's existence. Yeah. We cannot talk of existence when we are dealing with balance sheet. Sorry, with P&L items. So, you want to confirm that your revenue is complete. What do you do? Revenue. Yeah, you don't have a listing. So what do you do? What audit procedures do you think you can apply to confirm completeness of revenue? Joseph, tell us. Sorry? The what? Yes. Completeness of revenue. So, yes. Online team. So one of the things you can do is review the sequential numbering of invoices and check that they are all included in the financial statements or in the general ledger. Completeness, look at sequential. That's one. Any other we can do on completeness? The analytical procedure can be used on completeness of revenue. You compare current year revenue in the financial statements prior for and check that, and obtain explanations from management for any significant movement. Review the schedule of revenue. Your point is not complete, my friend. Occurrence. How would you confirm occurrence? We want to confirm that all the transactions that we have recorded in our revenue account have actually occurred, right? How do we validate this? So how would we do this? Check the revenue recognition criteria. I think this is correct. So you review the revenue recognition criteria and check that it complies with IFRS 15. Because IFRS 15 is what tells us how to recognize revenue. As long as you fulfill your performance obligations, you should be accounting for that, for the revenue, right? So if you meet people who are using like cash basis accounting and they're not accruing, they're not using accruals accounting, they could be culprits of having their revenue misstated because they've not complied with the standard IFRS 15. Check that the cash book for the cash sales and also the sales register. We're talking of which assertion or currency? Yeah, that's correct. So cash sales, for them to confirm that your cash money has to be on the account. Yes, please.
Has the round range been used of the checking correct? Is it appropriate in auditing? It's talking about checking the cash book.
Yes, it is correct. It is correct.
I thought that the most appropriate language could be review.
The most appropriate word could be review. If you can use review and you stick to review, well and good. But I've had somebody else ask me the same question, that someone told them that the word check is not supposed to be used, which that's what they told you in paper 9.
That it is not an audit word.
I
It is
don't know
an English
about that.
word.
So, okay, as far as I know, the word check can be used. Even when you go to the auditing standards, it is there, right? So, in as much as we're supposed to use like audit terminology, especially like in things to do with like risk assessment and stuff, but there's nothing like this is a dictionary for audit that we should be like really sticking to, right? So that's not a big deal. Actually, the word check is always going to be common in most of these areas where we have things to do with auditing procedures. Yeah. For as long as you're doing audit testing, the word check is really going to be part and parcel of what you're going to be writing. Yes.
This I say considering the bank statement, good positions.
On cash and bank, that is there's accuracy, but the accuracy for balance sheet is really always valuation. In as much as on balance, in as much as for bank balances, we're interested in the accuracy, but accuracy is not really a balance sheet assertion. Like we like using valuation, but in some cases, like when we are talking of bank, we talk of accuracy or valuation. When we are talking of stock, we also talk of accuracy or valuation. So I think it's either or. We need to have the right amounts of the bank balances or the right values, but then we also need to have accurate balances. I think it can be used interchangeably. So auditing procedures, the bottom line is you can use those assertions really to help you to come up with auditing procedures. So now I wanted to divert a little bit and talk about, there's one question, I think it should be in August 2024, if I'm not remembering badly. Anybody has it nearby? So the question, which was, I think a part B or C, was asking for auditing procedures for insurance. I think it was insurance premium income. No, it's not this that I'm looking for. Okay, I can also talk about this. So this question, no, this is which year? Where do I see the year? So, okay, August 2024, the question was asking, recommend the principal audit procedures to be performed at TLGL on recoverability of deferred tax assets. Then the other one was goodwill on consolidation. What audit procedures would you carry out on those two areas? What do you guys think of an area like that? Because here they've not asked you for the usual receivables, they've not asked you for the usual payables, but they've asked you for the auditing procedures that we can carry out on those two areas, goodwill on consolidation. Anybody has any suggestions? The first thing will be the free marks are going to, some of the free marks are going to apply, right? They are still going to apply, right? But also, that's why you need to become creative as you think about the auditing procedures, because now it just basically means that you're not going to be looking at it like in an ordinary way, but you're going to be looking at it like an area which is a bit like outside the normal audit procedures that we look at using the what? Using the assertions. So if we are to talk of recoverability of deferred tax assets, right? It's a deferred tax asset, right? Meaning it's a balance sheet item. The assertions that apply to balance sheet items will also apply to a deferred tax asset, right? So what are those assertions that are going to apply to? But in this case, we are talking of just the recoverability. So the recoverability, not all the assertions probably like valuation and the rest, but mainly focusing on recoverability. So the first thing will be, when you have a deferred tax asset, it's going to be coming from different aspects. It's going to be coming from different items that are causing the temporary differences, right? It could be like tax losses carried forward, right? It could be maybe temporary differences on property, plants, and equipment. Maybe it could be provisions for bad debts, right? It could be what? What else can it be? Or do you guys know deferred tax? Do you understand it? Christian, do you know deferred tax? Yes. Somehow. Okay, do you know deferred tax? So deferred tax is if I use like a very down to like if I try to break it down, deferred tax, we are looking at tax which is the tax effect of tax impact that will happen in future, right? Like the tax now, which will happen in future, right? If, for example, I do business and this is the financial year and I make a loss, right? It means that in future, I will carry forward this loss, right? Meaning that in future, when I become profitable, I will get a tax credit, right? But the credit is actually for this year, right? So what I have to do is that I have to recognize the credit in this year because that's when I have earned it, right? But the realization of this credit will happen in future when I become profitable. So in my financial statements, if I made a loss of 1 billion and the tax credit on that is loss of 1 billion, you carry it forward in future, right? So the tax credit, the tax impact on that loss is 300 million, right? So in your financial statement, you're supposed to have a tax credit in the P&L of 300 million, and then you have a deferred tax asset of 300 million. So when you become profitable and utilize your tax loss carried forward, then you're going to realize that credit that you earned in the previous year. So that if the rationale of IS 12 bringing in the impact of deferred tax, you want to ensure that these credits or these liabilities, you're recognizing them in the period when you actually do what? Earn them or incur them, right? You don't want to be accounting for that tax credit in the future when you become profitable. No, that tax credit happened in this year when you make the loss, right? So the question that we are being asked in this particular question is, what audit procedures would you carry out on the recoverability of this deferred tax asset. So the first thing you need to do, you need to understand the different items that are contributing to a deferred tax credits, right? You need to know what is giving me this deferred tax credit. Are they tax losses? Is it provision for bad debts? You know how we treat provision for bad debts in tax accounting? When you make provisions for bad debts, we add them back in the what? In the tax computation. Is that correct? But in future, when these debts finally become actually bad and you write them off, you get a deduction in your tax computation, right? So the reason why we take these bad debts into our deferred tax asset, it's because we've incurred them now, because that's when we provided for them. So in future, once we write them off and we realize that, we just are realizing the what? The asset, right? So if someone is asking me auditing procedures that I can apply to determine recoverability, assess or audit the recoverability of this deferred tax asset, the first thing is to understand the different items that contribute to the deferred tax asset in the financial statements, right? Then the second auditing procedure is going to be, you're going to review the conditions for recoverability of this asset and check that the company is complying with them. For example, because in Uganda they introduced the restriction of carrying forward tax losses, right? After 5 or 7 years, it's 5 years. Was it 5 years? 7. Yes, which one is which? 7 years. Okay, if it is 7 or 5 years, but after that, you only carry forward 50% of the losses, right? And there are countries that only restrict it to like 10 years, right? So if the losses that you have, if I am assessing recoverability of your deferred tax asset on your tax losses, I need to be sure that those tax losses can actually be carried forward. If they can't be carried forward, then you have no deferred tax asset. You could be lying to yourself, right? So that's why I was saying that you review the conditions for recoverability of the deferred tax asset and you verify that the company is still meeting those conditions. I hope you guys are not expecting me to be writing. Do you guys want me to write this? Because if we are to write, we'll spend a lot of time writing.
No, we are taking notes. Maybe you can just reduce the speed and as we are taking notes.
Cool.
Yes, we are writing.
Okay, cool. Sounds good. Yes, yes. If you say, as a procedure, they are deferred tax computation. Which assumption are you trying to address? Accuracy. That is so. So when they talk of recoverability of the deferred tax asset, what do we get to understand? Does the value also need to be audited? Or we are just auditing, whether they can actually recover this asset? Maybe both. how many years they can take to utilize it. I need to look at the question. Let me just look at the question again and see. The question is saying, recommend the principal audit procedures to be performed on recoverability of deferred tax assets. Recoverability of deferred tax assets. I think the message that I get is specifically on whether you can recover this asset. The bit of valuation, in as much as we might be tempted to put it, I don't know if it would really hold too much value. But like I get where you're coming from. Policies. So these are regulated things. Most of these are going to be regulated things. So the thing is, I have this deferred tax asset of say 1 billion, right? And you're auditing me, you want to see, will this guy actually recover this asset? That is what you're interested in, right? So the first thing we've said, yes. So the first thing we've said is you're going to obtain and review the items contributing to this deferred tax asset, right? The second thing we have said, you review the conditions for the recovery of the tax credits and check that the company is still complying with these conditions. Then the next procedure that we can do is verify the time period within which these assets will be utilized, or within which the company will generate the profit to utilize the deferred tax assets.
For the future.
Yeah, that sounds correct. So I think that's what I was saying. Verify the period over which the entity will generate profits to recover the assets. So what we are saying is that you're saying that you will recover these assets, but when are you going to actually recover them? That's the question you're trying. That's why we're saying you verify the period over which the entity will generate assets to utilize the deferred tax credits.
Victor, it implies that for some questions of the audit procedures, these assumptions are irrelevant.
Especially if it's not really like an area, if it is, because you see now like this one is something which is very, very specific to a particular thing. Like somebody is asking you on recoverability of deferred tax. It's not like they're asking you even audit procedures on deferred tax. If asking you for audit procedures on deferred tax, it would be easy. But recoverability, it's like part of the deferred tax here. Then the other thing that the other procedure you can do when it comes to this deferred tax asset, recoverability, it can be obtaining management representation letter with respect to recoverability of the deferred tax asset. That is going to apply. Obtain management representation letter with respect to recoverability of deferred tax, yes. Accounting policies that were used in the computation of deferred tax. Hmm. No.
What about if I say you recalculate the deferred tax to ascertain if the
I think
balance?
that can be correct. You can recalculate the deferred tax. The reason why recalculating can be correct is that this guy is saying that he has a deferred tax asset of 1 billion, right? Is it recoverable, right? I could go in and I'm recalculating, and I notice that maybe there are some things he did wrongly, right? If he did anything wrongly in his income tax computation, that could reduce the deferred tax asset, right? So I think that procedure should be correct. So you can recalculate the deferred tax asset and agree to the deferred tax asset computation prepared by management. Okay, goodwill and consolidation. What audit procedures can we carry out on goodwill and consolidation? Do we know how goodwill arises on consolidation? Because now we are going to audit that happens. Goodwill and consolidation. How does it happen? Tell us. Someone to tell us. The value of identifiable net assets being more, no, less than the purchase consideration. That's how goodwill arises, right? You have purchase consideration of 80 million. Let's assume it's dollars, $80 million, right? But actually the verifiable net assets is 70 million. The difference between those two numbers is what we call goodwill on consolidation, right? So how would you audit it? Thank you. So you got, yeah, 10 and 3. So you can review the goodwill computation and check that it agrees with the IFRS 10. So basically you're checking if I get the net asset and I subtract the purchase consideration, do I get the same value of goodwill that these people have obtained, that they have included in the financial statements, right? Then you review the purchase agreement and agree the purchase consideration to the purchase agreement. Because there will be support, right? If I bought this company, there's going to be what? Support documentation in form of the agreements, which will be specifying the purchase consideration. Then agree any cash payments to the bank statements. Agree any cash payments to the bank statement. Then the other thing you're going to do, since this is goodwill, you're going to, where would we find the value of net assets? You can review the company's valuation and verify and agree the fair value of net assets to the company's valuation report. You agree the fair value of net assets, the company's valuation report, and the due diligence report, right? I hope we are together. Yes.
I was told that
Thank you very much.
when
Review
we
both minutes.
are asked about
We are struggling
the
to hear your voices buffering up.
procedures.
Start afresh. We didn't hear the things you said. Start afresh. The question. From I was told that. Start from I was told that. Okay, so your procedure of review the board minutes for any discussions about the purchase. All those things are going to be happening in the what? Even the acquisition is going to be discussed and approved by the what? By the board. So review board minutes for any discussions relating to the purchase. Controlling interest. How does that affect the goodwill? Sorry? Said controlling interest.
Whether the right methods for measuring it are applied to the fair value and acquisition share.
For goodwill.
Check whether the non-controlling interests are
Do they have any share of goodwill? Yes. Oh, but you're not telling us everything. I don't know that detail, but yeah, but it could apply. The other thing is you discuss with management. We have goodwill, which we said that it has definite useful life, and then one which has indefinite useful life, right? If it has definite useful life, you amortize it over the useful life, right? And if it has indefinite useful life, you test for impairment annually, right? That is what we have in that accounting standard. So you can discuss with management the basis of this is the basis of measurement of goodwill or valuation of goodwill. Basis of valuation of goodwill. And check that it is appropriate. Are they saying it has definite useful life or they are saying it has indefinite useful life? So those are the audit procedures that like I just wanted to show you that they can ask you in any form. There's a paper, I think that means it must be December. Anybody has December 2024? December 2024 question. Number 1, like part B. That's from here. Yeah, so this is the one I was looking for. So I said part C was asking, advise the engagement team on the procedures to perform over insurance revenue. So this question was about an insurance company. And they're asking you revenue, not just any revenue, but insurance revenue, right? So the things we've been talking about will apply, but then somehow you might be expected to customize your points to make them mirror an actual operation of an insurance company, because this is insurance revenue they are talking about, right? So we'll still talk about our assertions and the different procedures. One, let's start with the free marks, right? You can compare the insurance revenue in the financial statements in the current year to the previous financial year and obtain explanations from management for any significant movements, right? How can we confirm that this insurance revenue actually occurred? Anybody can tell us how we can confirm that it occurred?
Which number was that?
That's number one, part C. That's December 2024. Hey, come on, guys. Occurrency. Okay, what's happening? Occurrency of revenue. What I'm trying to arrive at here is that what I want to put clear to you is that even as you read, especially for these auditing procedures, prepare for diverse possibilities. You're going to read your revenue properly, but the guy is going to ask you school fees revenue. You should be able to switch your mind to school fees revenue. But you won't have invoices, you won't have delivery notes. School fees, you just have probably enrollment, bank slips, those things you get. So you need to be able to tune your mind to switch according to the circumstances in the what? In the question. So insurance revenue, we have said, you can compare current year balance to the previous year and obtain explanation from management for any significant movements, right? If I want to confirm that this revenue actually occurred, right? I can obtain sample invoices to clients and check that the insurance policies were issued to clients. For the insurance company to give me an invoice, they should have given me a what? An insurance cover or policy, right? So you obtain a sample of insurance invoices or premium invoices and check that the policies have been issued to clients, right? That is an example. Which other assertion can we have? Cutoff. What do we do for cutoff? Hey, guys, we don't know what the procedure for cutoff. Oh. Yes, so you obtain the last sample, a sample of the last transactions, in this case, policies issued before year end and those issued after year end, and check that they've been recognized in the right period, right? Still on cutoff. Now, this is insurance. When you're dealing with insurance, we don't recognize the revenue like we are recognizing these sales that happen. If somebody buys their policy the 1st of July 2025, and it's going all the way up to 30th of June 2026, and they've paid 1 million premium. If I am accounting as at 31st of December 2025, I will only recognize 500K, and this 500K will go into the next what? Financial year. So you allocate the premium over the life of the what? Of the cover, right? So this is still part of cutoff, right? So you can review the insurance premium allocation and check that it has been appropriately allocated over the life of the insurance cover, right? This is cutoff. Just that this cutoff is specific to anything related to insurance. Are we together? We shall still obtain management representation later with respect to accounting treatment for insurance revenue, right? That will apply. If we want to confirm, which other section do we have? Accuracy. What procedure can we do? Accuracy. That should be the easiest, right? Someone tell us, Joseph. What would we do? What procedure would we carry out? Sorry? E. No. Accuracy. You're telling me something like completeness from what I'm hearing. IFRS 15. Yes, you can repeat, but it's not insurance. We don't apply IFRS 15. We apply IFRS 17. Yes. So you review the insurance, revenue, recognition, approach, and verify that it agrees with the requirements in IFRS 17, right? IFRS 17. The whole standard. It's revenue from insurance contract. Yeah. So that is, so don't be caught in between and you start talking of IFRS 15. No, here we shall be talking of IFRS 17 because it's the one that we apply as long as we are dealing with insurance. What we have on insurance, There are some things that could be a bit customized for insurance operations, but those are not the most common, like those are not the many. It's just a few that are specific to insurance operations.
Victor, I had a question.
Yes, please.
I was saying that I was told that when you are being asked a question about the audit procedures, you are supposed to print your answers into 3 categories. That is the test of control, test of details, and substantive procedures. That if you give a question which is one-sided, you lose marks. So kindly enlighten me with that concept that I'm having. Thank you.
Where did you hear that one from? Was it from the examiner? It was from who? So the truth of the first thing is the point in itself is correct, right? Like the audit procedures that we carry out, they are divided into 3 categories. Some are substantive tests of details, right? Some are tests of controls, and some are analytical procedures. I think like this point where we say you compare current year with prior, that is an analytical procedure, right? But what I am not aware of is that you have to categorize them there in those 3 categories. By default, they are going to be falling in different categories, but there's no requirement for you to come and say, now this is test of control. This is test of, no, there's nothing like that. And the bit of saying that you will fail to get marks because you didn't categorize them in the 3 categories, that is not.
No. It's not what I tried to mean. I was telling that if you give a question, if you answer that question when you are one-sided, you are most likely to lose marks. As in when you give out only the answers in line with the test of control, and you don't give the test of the details and the analytic, you are most likely to lose marks according to the market allocation of the examiner. That is what I was trying to mean.
Was it the examiner saying that? Because the question says this. I don't think really.
So that's not correct. So first of all, the thing is this: when you talk of these auditing procedures, when we are talking of these auditing procedures, if you are to talk of like something like controls, it's going to be 1 point, right? So there's not many points you're going to get out of this. If, for example, I was to talk of a procedure on test of controls, it's going to be review the insurance, revenue accounting controls and check that they are sufficient, right? That would be the procedure. So I don't expect you to have many points under test of controls. Analytical procedures, if you are lucky, something like revenue will have only 2 points, right? The rest of the things are always under substantive test of what? Test of details, right? So that's why I'm saying, whatever you're saying, the categorization is correct, like it's perfect. It will be there within your answers, but it's not a mandatory requirement that you have to bring out all the 3 categories for you to get the what? To get the marks. Because there's nothing like, oh, these marks are for test of controls, these marks are for test of data, and these marks are for whatever. No. All we want is you should have procedures, right? And they should be good enough to earn you the marks that you have on that question. Maybe one thing I can comment about, which could be related to what you are saying. If you go to areas like property, plant, and equipment, and you go to areas like inventory, they have like a lot of points on the assertion of valuation, right? Actually, for me, I would be okay if you gave points that cut across all assertions, so you do not concentrate on one assertion. That could be disastrous, right? Like if you give points that are centered around one assertion, right? But
Thank you.
By categorization, no. But assertions, I would recommend that you try as much as possible to ensure that you have touched all the what? All the assertions. So when somebody looks at your answer, it's not about depreciation, revaluation, excess depreciation, cost, and then it's like all around valuation, which is one assertion. Make sure you're addressing all assertions. But the categorization of test of control, test of details, analytical procedures, no. First of all, when you're doing an audit, right? I don't know if you guys remember from the planning stage, it could be the test of controls does not even apply to my particular client that I'm working on, right? So if it's not part of my strategy, I don't expect to be having what? Auditing procedures on test of controls, right? Analytical procedures may not be applicable. That is why in this section of topic C of auditing procedures, most of them are based on substantive test of details. We bring in test of controls as a by the way. We also bring in analytics as a by the way, not really too much. Most of the procedures are centered around test of details, because if test of controls does not apply and test of analytical process does not apply, then you have to stick to substantive test of details, which is like the fallback if all the other things have failed, right? And then also the other thing which is very clear in the standards is that even if you derive reliance from test of controls or analytical procedures, you still have to do some bare minimum test of details. I think there's another question on the chat, and it's asking what you are doing being the okay, this is what you are doing. It means and what it looks like in those things. I am lost. You can help me rewrite the message. I'm failing to connect it. So if you could rewrite the message and then okay. Yeah, so that's it on the insurance premium revenue. So you can also test the controls around insurance revenue, accounting, and check that they are appropriate. They ask you for school fees revenue, and that's the one you're auditing. Please make sure that you are thinking around the school. In the school, you're going to be looking at maybe the bank deposit slips. Maybe you're going to be looking at the enrollment, because remember in schools, income is earned per student, right? So you can compare the enrollment of students and the school fees structure and check that it agrees to the revenue in the what? In the financial statements. You'll still obtain these written representation letters. You'll still check that the school fees income is properly allocated over the financial period in case these are terms that are crossing from one financial year to another. You can still compare the revenue in the current year to the previous period. You can check the decrease or increase in the school fees to the increase in the number of students or students population. Those are the things that you're going to be dealing with, but you still can go assertion by assertion. You can check that the revenue being booked per student agrees to the school fees structure that is in place in the what? In the institution. So the whole point is to ensure that the way you are thinking and the way you're looking at these auditing procedures, you are looking at them with an open mind. You know the main talking points, and you can easily navigate from one sector, from one area to another. Okay. Any questions on audit procedures? Because I feel like we've had enough of this now. Yes. Sorry? What happened to your voice? Hmm? Yes. Test of control, substantive procedures, and subsequent events. Test of controls. What is test of controls? So test of controls, we have, when we are doing an audit, we have about 3 approaches that we can take, right? One is test of controls. I can do a test of controls. I can test the design and operating effectiveness of controls, and it helps me to get reliance. It helps me to get confidence about whether the financial statements are free from material misstatements, right? By testing the controls in the different areas of the financial reporting process. Because if you have controls, then the controls should be able to eliminate any misstatements from the financial statement. So that is why we say that one of the approaches you can use is to test the design and operating effectiveness of the controls, right? Then we have right? Looking at documentation, details. Then the other one is substantive. Procedures, basically where you are relating financial and non-financial. Right?
Deborah, please mute. Deborah.
Guys, please, you're interfering us.
Namuli, Deborah.
Yeah, so the part where we are looking at documentation, no, so I was talking of supplemental analytical procedures relating financial and non-financial information. We can also use that as an approach while we are gathering and obtaining this audit evidence that we are looking for. So all those approaches can be applied in audit testing. But of course, there are some conditions which we talked about previously during our study time that not all of them might be applicable. I can only use analytical procedures if I can use them. If there's not enough information for me to use analytical procedures, I might not use them. I can only do a test of controls if the controls are designed and operating effectively. But if the controls are ineffective, then I cannot do what? I cannot be thinking about doing a test of controls. You talked about subsequent. That's a different topic. You can go and read about it. But subsequent events are those events that are happening after the date of the financial statements or facts that are becoming known to the auditor after the date of the independent auditor's report. But there's like a lot more things there. We have audit procedures for identifying subsequent events. We have how do you respond to the different subsequent events as and when they become known. Okay. I think that's enough of auditing procedures. So please, when you go for your exam, as you're revising, please think about the 3 points, the things that are really constant all through, but also think about the assertions. Let the assertions help you to come up with these auditing procedures. Even when you're revising, make good use of the what? Of the assertions. They should help you to be able to articulate these auditing procedures very easily. Otherwise, if you choose to say that, let me cram them, it might be a very bad experience for you. Are we together? Okay. People ask about materialities. So, quality control, yeah, materiality. No, I'll pull that out after later. I need to get something from level 2. Yeah. So let's look at so the paper that we are looking at, March 2022, question 1 was about, I think, did you finish question 1? But we've talked about auditing procedures. Part C, Part C was asking us the audit work. The audit work. Give me 1 second. No, the class was being recorded. So don't get worried. The recording will be there. So the audit work for the year ended. So this particular question part, they were asking us to critically assess the following extracts from the draft auditor's report. And it was basis of opinion extract. Evidence available to us in respect of the intangible asset capitalized was limited because of restrictions imposed on our work by management. As a result, we have been unable to verify the appropriateness of the amount capitalized, and we are worried that the asset may be overvalued. Then opinion, disclaimer on view given by financial statements. Because of lack of evidence that we could gain over the intangible asset, we are unable to form an opinion as to whether the financial statements properly prepared, whether the financial statements are properly prepared in accordance with the relevant financial reporting framework. So they want us to critically examine the extract of this audit opinion. How are we supposed to assess this? How are we supposed to comment about this opinion? So what is the first thing? This is the issue of the intangible asset, the development, right? They were not given the evidence they needed, right? And this is the opinion they have issued. The problem is that the opinion is really looking very ugly. They've written it wrongly. If you remember very well, when we are talking about forming an opinion, there's wording that is used, whereby, for example, you're going to, like you put a basis of the, like you put the opinion first of all, like the opinion is what comes first, right? And then the opinion comes first, then the basis for opinion comes after. I hope you guys remember that. If you're looking at the format of the independent auditor's report, the opinion is what actually appears first, then the basis comes after that, right? And, so because remember, when we are giving an opinion, the first part that we begin with is, this was a bit harder because you needed to be knowing how the opinion actually looks like. We begin with opinion, right? And that paragraph of opinion, that's where we begin by saying that we have audited the financial statements of ABC Limited, which include statement of financial position, and all those things, right? And then you go ahead and say, in our opinion, the financial statements give a true and fair picture, right? And then after that, that's when you put basis for opinion, right? And we said that when you're giving modified opinion, you're not going to come and say basis for opinion, right? You come and say basis for qualified opinion, basis for disclaimer of opinion, or basis for adverse opinion. Here they are saying basis for opinion, which is what? Which is wrong. So the opinion is not being given the appropriate heading. It should have basis for disclaimer of opinion, right? Then the other thing which is happening here is that they are not mentioning the financial impact of the what? Because when you're mentioning, you should be able to come and say, we are not given access to maybe information affecting intangible asset, which is worth maybe 14 billion. And then you go ahead and talk about if it is material or not to the financial statement. So in this opinion, there's no mention of the financial quantification of the possible misstatement that we are having in this financial statement. Then the other thing which is happening is that there is use of inappropriate terminologies. Something like because of lack of evidence. I don't think there's anywhere where we have ever used the word like that, because of lack of evidence. It could be something like we were unable to obtain sufficient and appropriate audit evidence, not lack of evidence, right? Like those are the issues that, because the examiner had just said that we should critically assess. Those are the things that you should be highlighting that are coming up from this part, that are coming from this opinion. So they are using unprofessional words. Even the word like we are worried. The word like we are worried is not really, an appropriate terminology. So the words which are inappropriate there is lack of evidence, and then we are worried that the asset may be overvalued. Then the other thing which is the other thing which is happening in this paragraph. Okay, we talked about they are not mentioning the financial quantification in the paragraph, because they should have said that we are restricted from getting information affecting the valuation of an intangible asset worth maybe 14 billion. Then they should have added the fact that they are not able to obtain additional evidence, to obtain the evidence using any alternative audit procedures, right? If you got the different illustrations that we had in our notes, the different illustrations which we referred to, they have like the kind of wording and how it is supposed to be flowing. It is a very good benchmark to look at when you are like assessing such a report and you want to comment about it. Starting right from how they are heading it, how they are organizing their opinion, the kind of terminology they are using, how bad it is, and how off it is. Then you can highlight all those parts, all those aspects in this part, in this extract that we are having. They are also not referring to the respective accounting standard, right? For example, if they are saying, instead of saying, oh, this does not give us, maybe this is not consistent with IS 38 or whatever, they are just saying, we are worried of, like very random and professional words. So basically the opinion is supposed to be very precise. It should be referring to the applicable financial reporting standards, and it should be highlighting the impact of the restriction of access on the audit. Okay. That sounds like it on that question. Let's take a break of 10 minutes, then come look at materiality, and then we look at a bit of other assurance services. 10 minutes break. Oh, okay. Hi, you're welcome. Let's talk about TNT very quickly, and then we talk something around the national services. So, materiality, I don't know if but we cover this on level 2, but these are some of the common benchmarks that I use when computing materiality, right? At this level, I don't expect it to come as a detailed question. I expect it to come just part and parcel of question 1, right? Maybe just need to use a bit of your understanding to compute it. We have different benchmarks.
Mr. Victor, audio is not good.
You can use profit before tax. You can use profit after tax. You can use revenue. You can use gross profit. You can use total assets. You can use total expense. Now, all these benchmarks may not apply all companies, but they will vary depending on the nature of the entity. If, for example, you are an entity which is growing, right? You can use revenue as a benchmark. An entity which is early stage and still growing, the major focus of the users of the financial statements can actually be revenue, right? So you find that revenue is a good benchmark for such an entity. In year 1, year 2,
Now
year
come closer to the mic. We can't hear.
Is it better now?
Yes.
Yes.
Please repeat.
To year 3, year 4, they are going to be using revenue as their benchmark, right? If an entity is really not starting,
But we are not hearing you. We are missing out.
I don't know, like, is that applying to everyone or it's just this person is having a network issue?
No, it's like Victor, you're speaking to very far from your gadget.
Seems to be very fair.
I'm not sure because nothing has changed.
Please re-echo for us.
There's echo.
A little better.
Is this better now?
Yeah, that's better.
Yeah, it's better at least.
Yeah.
Please
So
don't leave that spot.
Yes,
But we missed the first session, so we request you repeat.
Okay, so I was saying that we have different benchmarks that we use when assessing materiality. And one thing that I was mentioning is that I don't expect like a full-blown question at this level, but it should be more of, can you use a bit of this knowledge from level 2 to be able to answer in case the examiner brings in the aspect of materiality, especially on number 1, and when you are responding to that question about reporting or about misstatements that may be existing in the financial statements. Now, we have these different benchmarks. These different benchmarks apply to entities which have different characteristics. The most commonly used are profit before tax, revenue, and then a few entities use total expenses. So the entities that use total expenses should really be manufacturing. The entities that use total expenses should be spending entities, NGOs and government entities, people whose money just goes into expenses. Those are the people that are supposed to be using total expenses as a benchmark for materiality, because the users of these financial statements care about how money is actually being what? Spent. You donor, you send
But they're never given. They always put their whatever. Eh? He has not even referred. He had
ABC,
always,
you're interfering.
ABC, you make a lot of noise.
maybe he had given it to the employer. I don't know. Thank you.
please mute yourself. Yeah, so if you give a donor an accountability or a financial report for an NGO to the donor, he's just interested in how money is being spent. So that is why total expenditure ends up being like the best benchmark when it comes to assessing materiality for a spending entity like an NGO. Same thing applies to government. I don't think anybody who looks at government reports even looks at revenue. No, that one we know by default, it's there. The tax authority collects it. People are always looking at expenses. This one has gone to classified expenditure. This one has gone to, so people are interested in how money is being spent. Now, entities that are profit making, the private owned entities that are profit oriented, those ones, the best benchmark is always what? Profit before tax. Could be profit before tax or profit after tax, but most commonly it's profit before tax. Then for entities which are growing, I had already mentioned that these ones use revenue, right? Entities which are growing use revenue, or entities whose profit is very unstable. This year you have profit of 2 billion. Next year you have a loss of 3 billion. Next time you have, like, if it is very unstable, then something which is unstable is not a good benchmark for materiality. An entity could be very profit oriented, but because their profit before tax is unstable, then you choose to use revenue, because at the end of the day, revenue is what results into profit. That is the bottom line of your what? Of your profit or loss statement. Then entities that are highly dependent on assets or which are highly capitalized, those are the entities where we normally use total assets. Very good example is like real estate businesses, right? We use total assets. Another example, sometimes even in some banks, we could use total assets, right? Because some of them, we know, like banking largely depends on the loan book for it to survive. They need to have enough loans and advances out there, right? But because some banks are listed, some banks have already matured, right? You find that the best benchmark is profit. I mean, profit performance. But in some cases, you could use total assets. Then another kind of business where total assets becomes an appropriate benchmark is retirement benefit schemes. Because, you know, if you got any retirement benefit scheme, they just have people's money, those investments, and that's why they are playing around to do what? So every person, every user of financial statements of a retirement benefit scheme or a pension fund, they're interested in the safety of their what? Of their assets. That's their money, which is in that what? In that entity. So asset-based businesses, total assets is the best benchmark. Growing entities or entities where the level of profit is unstable, we use revenue. And then total expenses is mainly for spending entities like NGOs, government, and the like. Those are the entities that use total expenses as the benchmark. Now, what are you supposed to know? When you're answering, sometimes you might want to bring in the aspect of what? Of materiality, right? I think I've seen only once when the examiner has said that the entity suitable benchmark for materiality is this. In most of the times, they might not tell you, right? So you should be able to use your professional judgment based on understanding of this information, come up with a suitable benchmark, right? that you want to use in case you want to incorporate this in your commentary. Then the next thing that you need to know is these percentages, how do we use them? The lower percentage is for high risk, right? No. The lower percentage is for, lower percentage is for high risk. And the upper percentage is for low risk. I don't know if you remember the relationship between risk and materiality, but the higher the risk, then the more the audit procedures you need to do. And because you need to do more audit procedures, you need to set your materiality levels to be low, right? So that you're able to do more procedures. But if you have a lower risk, you don't really need to do a lot of procedures, and therefore you can set high materiality, because your materiality is what is going to set for you what you should be focusing on and what you shouldn't be focusing on. And you can only choose to be, if the risk is what? If the risk is low. That is when you have the leeway of choosing not to be very strict or not to concentrate on each and every detail. So while you're using these benchmarks, the percentages you apply will depend on your assessment of the overall risk of material misstatements associated with this kind of entity that you are auditing. Let me see if I have like an example. Sorry? In case you're given the financial statement. If I use, let me see if I can use the question that we were looking at. So the question that we are looking at earlier, what was the kind of, when I look at this entity, I think it's a trading entity, right? I can choose to say that my materiality is going to be based on operating profit, right? No, profit before tax. I can use profit before tax, right? So how am I supposed to, I don't know, is it a high risk engagement or a low risk engagement? So my benchmark, my suitable benchmark is profit before tax, because this entity is a privately owned entity, right? It's not explicitly spelled, but when I look at it, this is a private entity based even on just the financial statements and how they look like. So that means that I can use my profit before tax as a suitable benchmark for computing my materiality. Now, when I use profit before tax, it takes me back to this table. Profit before tax, I don't know if you guys are going to cram them or you already know them. These are not like, this is the thing. Materiality is judgmental. If you go in the paper and the examiner has given you profit before tax and they've given you 10%, please take that, right? This is only like a guide. Even when you go to the standard, ISA 320, they are going to tell you that materiality is judgmental, right? So the bands that you would find in any standard or any manual or in any paper, just know that they are there for what? For guidance. But these which are here are the ones you're most of the times going to find in different places. So if I choose that I'm going to use profit before tax, my benchmark for materiality is supposed to be 5%, right? So I will get 5% times 8,316. Is that the number? Yes. And it will give me 415 million, right? So 5% times my benchmark. And I said that my benchmark is profit before tax. When I multiply my benchmark with 5%, it gives me 415, 800 million. So that would mean that altogether,
Victor, pardon on that.
one, we have said that this entity is a trading entity, a private entity, right? So what is the suitable benchmark for this materiality computation? Profit before tax, right? We said this is the suitable benchmark for privately owned entities and small entities like retailers. And what that means is that if I choose that as my benchmark, the appropriate percentage that I should be using is supposed to be 5%, right? So 5% is my materiality percentage, right? So that means that my materiality percentage is going to be, give me 1 second. Oh. So my materiality percentage is going to be 5%, and my profit before tax is 8316. My profit before tax is 8316, right? So meaning that my overall materiality is going to be 5% times 8316, which gives me 415. Then my performance materiality, now this is another judgmental thing. I don't even know. But it normally ranges from like 75 to 85. So I can choose to say 80% times overall materiality. Yes. Then trivial, but normally if the examiner is interested in asking the question, they will tell you overall materiality is, the benchmark is this, overall materiality is maybe, so they may choose not to mention because we already have a bit of guide, but they will tell you that performance materiality is maybe 75% or 80%. Then trivial materiality, they can also mention it. It's normally 3 to 5, sometimes 1 to 5, but you know, in most cases they use 3%. Trivial materiality is also a percentage of overall materiality. So what that means is that for anything that is below 12 million, you do not care. For anything that is above 415 million, you care because that is material and it affects the what? The decisions of the users who are using these financial statements. Yes. Sorry? If you use total assets. If you use total assets as your benchmark, then you have to take the percentages which are under total assets, the percentages which we have there. How much do we have? 1 to 2. So yes, we can choose to say if it is high risk, 1%. Sorry? Yeah, I think they will mention it. The examiner will mention it. At this level, by the way, I expect the examiner to mention all those details you need to compute materiality. It's not very common for it to leave it open, like you expect it to be to sit and assume, right? The examiner is supposed to mention the performance materiality and trivial materiality. The examiner is supposed to mention if it's high risk or low risk. If it doesn't mention whether it's high risk or low risk, then you should use your professional judgment. Look at the issues which are being mentioned. Like in this case, where we are having all these issues of misstatements, you cannot say it's low risk engagement. It should definitely be a high risk engagement, right? And most of the times, a question they ask for number one, because there's like all these issues to do with risk assessment, you find there's like many issues that the engagement just qualifies to end up being a what? A high risk engagement. But I think if the examiner wants to additionally ask you around materiality, then they should be able to mention some of those details which you need to do what? To be able to compute the materiality. Hope we are together there. The time is
Yes.
right. I wanted us, yes, I wanted us to talk about a bit about but now I'm seeing the time is gone, about other assurance services, but I don't know.
We are here. We are here.
Time is not our best ally. So, okay, as I pull out something on other assurance services, let's talk about, so when you're giving your solutions, so when you're giving your answers, try to always ensure that you, 1 second. Okay, so under other assurance services, we have uh, forensic investigations. Lately, it's one topic which is appearing so much in most of the papers, right? So if you, as you're doing your revision, please take a bit of time and look uh, at forensic investigation, especially like the objectives and the procedures on how forensic audits are actually performed. It's one of the questions which is featuring in most of the papers that the examiners are putting out there for people to attempt. Objectives of a forensic investigation and how forensic investigations are actually performed, how they are conducted. It's very, 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 very common of late. I think I think we looked at it maybe sometime in one of the discussions that we had, but like things around when you're doing a forensic investigation, we said you do a forensic investigation when there is a certain wrongdoing somewhere, right? Maybe there's been fraud, there's been mainly fraud, I would say. That's one of the things that in typical business setup results into a forensic investigation. And of course, at the end of the day, there's going to be things like resolving disputes, disagreements, and stuff like that. So when it comes to the objective, what you're looking out for is to ensure that you ascertain the exact type of fraud that has taken place, and also be able to know how long it has been taking place. You want to identify the people that have been involved in this fraud. Then you also want to ensure that you quantify the financial loss that has been incurred by the company. you want to ensure that you prepare a report that is going to be used in legal proceedings or in resolving this dispute. And then you're also going to want to ensure that you provide recommendations on how this fraud can be avoided. Those are the objectives of carrying out a forensic investigation. Then when it comes to how it is conducted, how do we exactly carry out a forensic investigation? What procedures are we going to carry out? We have, discussions with management, we carry out interviews, we review documentation, we can obtain confirmations from external parties, and all those are going to help you with gathering evidence when it comes to forensic investigation. Then we also have I think the audit procedures during the forensic investigation, the ones which are more or less like a step-by-step approach, right? I don't know if there are procedures. These are ways of getting evidence in a forensic investigation, but then we have the procedures whereby you first develop an understanding of the organization and its environment. You identify the control weaknesses that resulted into this fraud happening. Then you determine which people were involved. You look at their roles and responsibilities, and you're able to identify the transactions they've participated in. Then you extend the scope of your investigation to like all the transactions that these people have been involved in, so that you're able to start from nothing, and you're able to ensure that you cover every aspect of the organization where there is a possibility of fraud actually happening. So you need to also know those techniques that are used when we are carrying out forensic investigations. There are not many. I think it's a few-step approach that is used in carrying out these forensic investigations. Then the other thing that you can look out for that is sometimes lumped up with other numbers in section B is money laundering. I know it's a topic, it's a level 2 topic, so at this level, most of us normally do not read it. Yes, but it's a very precise topic. It's not like it's a topic you're going to need the entire day reading. Knowing the stages in money laundering, that is very, very easy. First, what are the stages? Placement, layering, and integration. Those are the 3 stages that we have in money laundering. Get a basic understanding of them, then you can be able to explain them. Then the other thing you need to understand is the penalties for money laundering, right? Why are you looking at me like that? There are penalties for money laundering. Why don't you want to? There are penalties for money laundering, right? So then the responsibilities of an accountant in controlling money laundering. What are you supposed to do with respect to money laundering as a professional accountant, right? And then I think there are also, the penalties are not common actually. What is common are the offenses under the Anti-Money Laundering Act. The offenses are the ones which are commonly examined, I mean. Not penalties. Of course, the offenses we're looking at Like if you do not register, if you do not screen, if you tip off people, if you withhold any evidence, if you do not report suspicious transactions, there's like many things right under there, under the offenses. Then the other thing should be the roles and responsibilities of a money laundering and reporting officer. Money laundering reporting and control officer. Then internal auditing is also sometimes asked. So if you can, please, as you revise, please take a look at internal auditing. Sorry? Is it the same thing? Value for money audits, it's under other assurance services, I think. And value for money, it's that kind of audit where we are looking at three things. There are three E's: efficiency, effectiveness, and economy in using resources. It's the kind of audit which is common in spending entities, governments, and not-for-profit, or those donor-funded projects. It doesn't have like many things around it, but they can ask you the procedures you carry out and a value for money audit. Then what else did I want to mention? Group audits. The only thing about group audits and why I even wanted to mention it is that group audits can even be asked on number one. So when something is asked on number one, you have no choice but to do what? Attempt it, right? So what do we look out for under group audits? One, and very important, is somebody is talking of risk management framework. That one I already mentioned it at the start. It's normally combined with the number on quality control. I think like in the last 3 papers which have been set, the question on risk assessment has always been combined with the number on practice management. But risk management is easy. Like it has like 3 sections and all of them are very straightforward. So I'll just urge you to go and read about risk assessment. So group audits, what do you need to know? The first thing is we need to know understanding the group and its environment. That is one area which is, if the examiner is to ask, they normally ask about it. Understanding the group and its environment. What are those things that you are going to consider when you are obtaining an understanding of the group and its components and their environment? Where we have the group-wide controls, what do you need to understand about the group-wide controls? Where we have the consolidation process, and under consolidation process, we have 3 things. We have matters to do with the financial reporting framework. We have matters to do with consolidation process itself. Then we have matters relating to consolidation adjustments. Actually, those 3 sections under consolidation process, I think are one of the parts that normally appear at least in every question where they are talking about group audit. So group-wide controls, just like an overview, we know that these are controls which are implemented over group financial reporting, right? Group-wide controls, we're talking of controls, but which are applied on group financial reporting. So these are the controls the group company puts in place to ensure that their consolidated financial statements are free from material misstatements. Things like how they manage and how they monitor operating results, having regular meetings between the group and its subsidiaries, how they are eliminating those intra-group transactions. Most of the companies which are group companies, you find that they have properly monitored intercompany balances and transactions, right? Ensure that at the end of the day, these intercompany transactions do not result into misstatements in the financial statement. Those controls include even having an IT environment, an IT system set up to enable consolidation, right? Having the group internal audit departments, right? So those are things like monitoring of controls at group level, right? You cannot just have a group and hope that all the controls are working, but you also have to have a process that you're going to keep using to monitor your controls at group level. Having a group risk assessment process, right? That contributes directly to your group financial reporting. Having a proper organizational structure, that is the process for assigning responsibilities and roles and authority within the what? Within the group. So those are some of the examples, some of the things that we have in the consolidation, sorry, in the group-wide controls. Then when it comes to understanding the consolidation process, that's where we have three parts, right? Where we have matters to do with the financial reporting framework. And when we talk of matters to do with the financial reporting framework, we're basically talking of do people understand the financial reporting framework that is being used within the group? Are we having a proper process for identifying components that we need to be consolidating? Are we having a process for identifying reportable segments? Are the accounting policies that we are using in these group financial statements actually consistent? Are they in line with the applicable financial reporting framework? Do we have a process to identify related party relationships and transactions? Then how do we deal with entities that have a different financial reporting year-end date from the rest of the group? When it comes to the consolidation process, we also have things that you have to basically understand. Things like how is your IT system designed to consolidate, right? You find these group companies, they have like a software in that for all the group entities, they are in there and the system just updates automatically, right? Otherwise, if you do not have a system like that, you could end up, struggling, right? Still in the consolidation process, do you have consistent accounting policies? If you don't have consistent accounting policies, you're going to struggle with consolidation. If somebody brings evaluation model, the other brings cost model, the other brings fair value, and then you have to consolidate them, how are you even going to deal with different accounting policies? Those are issues to do with consolidation process. How do you ensure that this information which is coming from subsidiaries is actually complete, is actually accurate, right? People who work with group companies, you find they have deadlines. By the 5th of the next month, you need to have all your transactions booked and accounted for so that the review can happen and the consolidation can also continue to take place. Still under consolidation, how are you going to translate different subsidiaries from different local currencies? Because when you're operating as a group, one of the risks you have is you can just get errors in your financial statements just because of how you are translating things from one currency to the other. So when we talk of understanding the matters related to the consolidation process, we are looking at the actual process of adding up these numbers into the group account. How is it designed and how well is it controlled to ensure that we do not have misstatement. Then when we talk of matters to do with consolidation adjustments, we are looking at which adjustments are required in your consolidation. How do we identify them? How do we identify those adjustments? How do we initiate them? How do we get them reviewed and approved before they are posted into the what? Into the consolidated financial statements. What are the, the transactions which are resulting into consolidation adjustments, are they having a business rationale behind them? Or are people just playing around with numbers, to achieve whatever they want to achieve, right? Then when you're talking of financial reporting, so when you're talking of adjustments which are required by the standards, it depends on the nature of the business, right? Like, are there those that are required by, like if, for example, I am a kind of business where we do intercompany trading, I automatically know that maybe if I am a stock-based business, I know that there's going to be maybe elimination of unrealized profit on closing stock because of the nature of the business that I do. So when you are understanding those consolidation adjustments, you have to think about those which are required by the financial reporting framework that you are using as an entity. How do you monitor your related party transactions? How do you reconcile them? And how do you eliminate them from the consolidated financial statements? That's very, very important. Then what are the arrangements that you have with certain maybe major or minority shareholders? Then how are you arriving at things like goodwill, and how are you treating it subsequently in your financial statement? Those are some of the things that can actually bring or introduce misstatements in your financial statement. Things like goodwill, which enter in once, and for the rest of the life of the company, you have to keep either amortizing or assessing for impairment, till when you get rid of those transactions. So you need to understand those three sections because they are very, 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 very commonly examined. Then the other one, which is good to understand, are the audit procedures for auditing consolidation. Remember, under group audits, the only thing that the group auditor does is auditing the consolidation process. Because remember, the subsidiaries are audited by the different auditors in those different countries for those different subsidiaries. So the group auditor is the one that audits the what? The consolidation process. He's the one who ensures that if you have country A, country B, country C, and these are making up your group, he's the one who ensures that what is in country E is what has made it to the consolidated. What is in country B is what has made it to the consolidated financial statement. So when it comes to auditing the consolidated financial statements, it is the group auditor that actually does what? Those audit procedures. So we also have to know the audit procedures for the group for auditing the consolidation process. This one will not be like the ones that we are saying obtain management representation later. This one might not do what? Not be the same. These are a bit different because when you're auditing the consolidation process, you're looking at how things are being. The first one you look at. What do you look at? You look at how different entities are identified and classified within the group, right? So you evaluate that this identification and classification is appropriate in the group financial statements. I don't know if you remember, but when you're doing a number on consolidation from your financial reporting, the first thing you begin with is the group structure, not so? you check if the shareholding is above 51%, because that is what gives you basis for consolidation. So me, when I'm auditing, I am going to ask, give me your group structure, right? Which entity owns which entity and by what percentage? Then I will see if all the entities which should appear in the consolidation have actually appeared in the consolidation. That's why we're saying that you evaluate the basis for classification of components for consolidation purposes. It's a very important auditing procedure. Then the other thing that we do in financial reporting when we are consolidating is we used to call it, I remember at university, line by line addition, right? Of your consolidation, right? So you still have to check that the amount included in the consolidated financial statements have been properly extracted from the subcomponent financial statements, right? Because you want to come and see, I have A, B, and C. Do they match with consolidated? When I add A, B, and C, do they actually give me consolidated financial statements? One of the things that I do at the end of the year when I'm preparing for my audit is prepare a consolidation reconciliation, because I have like different entities that I do financials for, including the group. So before I submit the group financials to my external auditors for audit, I have to give them a consolidation reconciliation, and it is always going to be country A, say Uganda, Kenya, Rwanda, Tanzania, and then I have to show that the addition of these numbers actually is what fits into my consolidated financial statement. Should I have any variance? I feel like your consolidation is actually not that accurate. So for them, they are just going to look at if the addition, if this is matching. I have to be able to demonstrate that all the countries added is what is fitting into my group financial statements. Then you're going to review the necessary disclosures in the financial statements as required by the financial reporting framework. Then you also
for foreign transition.
Sorry?
You also review the foreign translations
I'm not
for
getting you
different
very well. You're breaking, we can't really hear you. So the procedure that you do is you gather evidence on the different consolidation adjustments. Remember when I already mentioned that the only person who audits the consolidation is the group auditor, right? So because it's a group auditor, he's the one who has to get evidence on all consolidation adjustments. Every subsidiary will care about their audit and their component auditor. But the group auditor has to get evidence that if it is elimination of intercompany transactions, that has actually happened correctly. So you have to ensure
the
that
foreign
you obtain evidence.
translations for different components.
You're breaking, we cannot hear you. So maybe not until you have better network, then we can be able to hear your contribution.
Maybe she can type in the chat.
Yeah. So the other thing that you do as a group auditor as part of audit procedures for the consolidation is you investigate the treatment of components with a different year end from the rest of the group. So there are about just 5 procedures which are very easy to do what? To cope up with. Then the other thing that I would want you to understand on a group audit are the communications that happen. What is communicated by the component auditor to the group auditor, and what is communicated by the component auditor, group auditor to the component auditor, and then the component auditor to the group auditor. We know that the group auditor gives group audit instructions to the component auditor, right? So you need to be able to read that and look at what are the different things that are included in the group audit instruction. And then what does the component auditor in return communicate to the group auditor once the audit is done, right? So you need to be able to look out for those as your group audits, because those are the key sections that make up that topic of group audit. Oh, so I'll pause it there, and if you guys have any questions, please feel free. Do you have any question? Anything you want to clarify? Please send me a WhatsApp on this number. Do not call, just WhatsApp, then I will respond. You only call if I have not responded to your WhatsApp for over like 8 hours. Any closing questions that anybody has? Can we address other assurance services? Pastor Monday, we are out of time. Are we going to have another class? No. The only other class which will happen is you reading and making sure you're ready for the what? For the paper. But if you're revising and you have anything that is not clear, anything that is confusing you, please do not hesitate to do what? To reach out, right? If you're there and you're doing your private revision and you want to do a question, especially on number one, feel free to do your question and send me. I can be able to mark you and correct you where you're getting it wrong, right? Especially the number on audit risk assessment, if you find it interesting for you to do. But we won't have any other class. You can reach out and ask if you have any inquiries, if you have anything which is confusing you. Otherwise, I now set you guys free to go and face the examiner. Thank you very much, and have a great evening.
Thank you too.
Thank you.
Thank you so much, Victor. It has been great interacting, and we are looking forward to excelling.
Sure, all the best.
Thank you.
Thank you, Victor. I'll be disturbing you.
No worries, you're welcome.
Someone is asking me, when is the paper? Can you imagine?
Pastor Mande, what is you asking?
The
That
paper is on the
question.
11th of December.
See. Eh? Gracias. Aqui na Inglaterra, aqui na Inglaterra, não era um carro variado lá de Magaio um grave. Antes mas mania. Hata msangano kayo mkaka. Sasa kache mno. Our kupiana no kahur. It was not a small thing. The moment you